Hello, everybody. My name is Bennett Tchaikovsky, and welcome to Accounting, a Space-Time Odyssey. So this question is an absolute trip. I've probably spent the last 40 minutes of my time analyzing it. So you're now going to see the benefit of the analysis, as well as I will tell you also why the textbook is incorrect in one of its solutions. So the first thing right over here is that this is sales with returns. Now, I know for some of you, it's been a little while in terms of going back over and how do we go through and record inventory transactions. So let's just take a little trip down memory lane. So the first thing is we have sales. When we're going through and we are recording a sale, we're going to debit accounts receivable, credit sales. Then I need to debit cost of goods sold, and I am crediting inventory to show the inventory coming off of my books. This is how I generally record every single type of sales transaction. Then in terms of throughout the period, what I do is say if a customer returns something to me, right? So there's three, okay, so this is the sale. And one of the things is so we make this sale, and then what can happen? Right? Well, there's generally going to be three things that can happen. The customer can return an item. We can give the customer a sales allowance, and then we can give the customer a sales discount if they pay within the time period. So when a customer returns an item, there's a few different things going on. So when a customer returns an item, we are physically getting back that product. So what we'll need to do is, in this case right here, is I'm going to have to debit basically an account called sales, returns, and allowances. And what this is known as, this is what we call a contra-revenue account. Okay, so because it's reducing this. Once we record sales, we really don't mess with it. So we've got over here, we've got sales, returns, and allowances. And then what I am going through and then doing is I would be crediting accounts receivable. Now, that's the first part of this. Because if we are physically receiving the products back, then what I need to do is I need to show this inventory coming back onto my books. So I'm going to debit returned inventory, which is an asset. And why am I calling it returned inventory? Well, under law, if I receive items back from a customer, I cannot call it regular inventory. I have to call it, basically, it's essentially, I have to call it refurbished. Go to woot.com and you'll see exactly what I mean. You can't sell something as new. So I'm debiting return inventory, and then I am crediting cost of goods sold, okay? So this is for a sales return. If I'm giving the customer a sales allowance, it looks like this. Sales returns and allowances, and then crediting AR. And then if I'm basically if they're paying me within the time period for the discount, sales discounts, cash, and then I'm crediting AR. And that sales discount is also a contra-revenue account. If this does not look familiar to you, what I'm going to suggest that you do is you go into the modules or find the video that I have done on Canvas relating to inventory, and I will go through and do this. Okay, let's go through and now take a look at our problem. So sales with returns. Organic Growth Company is presently testing a number of new agricultural seed planters that it has recently developed. To stimulate interest, it has decided to grant 5 of its largest customers the unconditional right of return. Okay, this is huge, okay? What does this mean? They can return it whenever they want to, okay? So the right of return extends for 4 months. Organic Growth estimates returns of 20%. Now, Organic Growth has obviously been in business for some time, because if this was a new company, you would not touch the revenue until that unconditional right of return passed. So here they're estimating returns of 20%. Organic Growth sells these planters on account for $1.5 million, cost $750 on January 2nd. Customers are required to pay the full amount by March 15th. So the one thing this problem doesn't do is it doesn't say that the cash payment was received on March 15th. So we're going to assume that that actually happened, okay? Now, there are two different methodologies for recording these transactions. One is we're going to go ahead and record the sales at 1.5 million. But when we get to the quarter end or when we get to the financial results on March 31st, then we're going to have to go through and make adjustments. The second way that I will also go over, and we'll take a look at the book solutions, is if you're recording it on a net basis, meaning that when you're initially recording the sale, you do not recognize the full amount of revenue. So let's do the traditional way first. So my journal entry here on 1/1, let's see here, on January 2nd. So it's not Tchaikovsky's accounting New Year problem. Okay, so I'm recording the sale. So here I'm going to be debiting accounts receivable by credit sales revenue. I'm going to do this for the full amount of 1.5 million. Okay, and this is knowing that I have a 20% amount that I'm going to need to adjust for. So just if you had to prepare financial statements on January 3rd, you'd have to make an adjustment for this, but we're going to be doing it as of March 31st. So that's to record the sale right over here of 1.5 million. I'm selling these planners on account. That means it's 1.5 million. The next thing I'm going to go through and do is I have to show that inventory coming off of my books. I'm going to debit cost of goods sold. I'm going to credit inventory. And this is going to be for 750,000. And we'll go ahead and do that right there. Okay, so that is my first sale. Now, on March 1st, we receive items back from a customer. So on March 1st, due to unsatisfactory performance, prepare the journal entry to record this transaction, assuming the customer purchased 100,000 in planters from organic growth. Another thing I also want to mention here too is that if this is an indicator that everything's bad, you're going to have to basically, I want to call it debook the revenue, but you're going to have to reserve against it. So right over here, I'm going to have sales, returns, and allowances. Okay, so this is what I was going over before. So debit, sales, returns, and allowances, credit accounts receivable. So my sales, returns, and allowances are 100,000. And my accounts receivable is 100,000. So let's also go through here and input in these initial amounts. So on 1/2, I had accounts receivable of 1.5 million, sales revenue of 1.5 million. On January 2nd, I'm also debiting cost of goods sold of 750, and I'm crediting inventory here on January 2nd as of 750. When the items are returned, right, I'm debiting sales, returns, and allowances. Again, what is a sales return? I'm physically getting it back. What is an allowance? I tell the customer to keep the item. Here's a discount off your bill. So this is on March 1st. For March 1st, I'm debiting this by $100,000. And then I'm crediting accounts receivable for $100,000. Okay, now I have to show the inventory coming back on to my books. So over here, because they are the profit margin on this inventory, they account for 1.5 million, cost of 750. So the cost of these 100,000 is basically going to be half of the value, right? So if my sales price is, or basically if my cost of goods sold here was 750, my total sales revenue here is 1.5, so I have a 50% margin. So the value of that inventory coming back to me is going to be half of this, or $50,000. So here I'm going to multiply this by 0.5. And this is going to be a debit to cost of goods sold, and I just made a mistake on that. And let's make these all dollar amounts so we can understand this. Okay, so then the other thing I'm going to have to do here, returned inventory. This is an asset, right? I'm just calling it returned inventory. We're now in intermediate accounting land, and so I would want to separate this type of inventory from you know, my other types of inventory, which is here, which is really what I'm actively selling. And then also too, I debited cost of goods sold for 50,000. Okay, so that's how I handle the sales return. And let's just see this 100,000 up here. Just want to make sure that I'm putting everything here correctly. And we'll just make some little formatting here to make it nice and perfect. There we go. Okay. All right. So I've got that. And so also to record sales transactions, record sale, to record sales return from blank, the customer. This is date, account, debit, credit. Okay, so we're now through over here on March 1st. Now, the other thing I told you to remember is that our customers went through and paid us, okay? So they paid, but we have to assume that they paid, everybody here paid the full amount on March 15th. So how much do they owe me as of March 15th? So the amount owed of March 15th is going to basically be here my accounts receivable. So my accounts receivable as of March 15th was roughly, actually. So my accounts receivable right over here was 1.4 million, okay? So with this right over here, I'm just gonna give ourselves a little bit more room. Okay. So if I'm receiving cash of 1.4 million, which is the amount that is owed to me on March 15th, what I'm then going to go through and do is I'm going to go right over here. Let's see if we can get this to work. Oh, perfect. Okay. So, and let me get rid of this line here. So my T accounts with Bennett Tchaikovsky, unlike Bob Ross, is not working out perfectly. So we got to make sure we put those things in the proper place. Okay. So now they're paying me on March 15th, right? So the amount that's going to be owed on March 15th, I'm receiving cash of 1.4 million. Okay, and then I'm going to be crediting accounts receivable for 1.4 million. Okay, so this amount is now 0. Okay, and I've got cash over here now of 1.4 million from March 15th. Okay, so now I get to March 31st. Okay, my problem is on March 31st, right? I cannot record this full amount of revenue. And the reason is, well, I can record a lot of it, but I can't record everything. And the reason is there is an unconditional right of return. Because of that unconditional right of return, I'm going to have to go through and figure out, it's like, okay, what is the total estimate that I had made in terms of returns? So let's go through up here. It extends for 4 months. It's unconditional. So what I need to do is I need to say to myself, okay, my sales amount that I originally sold it for was 1.5 million, okay? My estimated returns were 20% of this amount. So when I multiply 1.5 million by 20%, I'm going to get 300,000. Okay, so this is my total estimated returns. Okay, so it's my initial sales. I said, okay, I'm estimating it's going to be a 20% return. Okay, These are my estimated returns. My returns to date on March 1st is going to be right up here at $100,000, which was my sales return. So essentially, remaining estimated returns is going to be at $200,000. So what I need to do now is, because there is an unconditional right, and because I'm estimating this to be at 20%, I have to assume that I'm going to be getting back $200,000 worth of items. How do I go through and do this? So the way to do this, okay, is, and this is what's kind of funky, but just let's roll with it. So the first thing I need to go through and do is I need to say, okay, I'm going to create an account here called Sales, Returns, and Allowances. Because, excuse me, I'm going to basically debit sales returns, and allowances, because I basically need to assume that I'm going to be having another $200,000 being returned because of the unconditional right to basically to turn it back in. Now, what's interesting here is that we have been fully paid off on this accounts receivable. In your book, there's this allowance for returns and allowances, or allowance for sales returns. Now, this is really essentially a liability. But when I see this, I was actually thinking, oh, it's going to be some kind of contra-asset account. But I think it's more of a liability. So the thing I would do is I would probably be crediting accounts payable. Now, the reason why I do this is simply because the customers owe me no more money. So if I hadn't been paid, right, I could use something like estimated, you could use something like an allowance for sales returns. But in this case here, I probably want to use accounts payable or another liability account, okay? So that's the first part. Now, if I'm getting these back, meaning that they have to return them, then I also have to show my estimated returns coming back. So I don't want to call this returned inventory, okay? Very important. Rather, what I would want to go through and call this is estimated inventory returns. And I'm going to be debiting this here for 100,000. Where am I getting 100,000? I sold the products for 1.5 million. It cost me 750. 50% profit margin. Okay, so I'm debiting estimated inventory returns, and then I'm crediting cost of goods sold. Now, what I have a problem with is estimated inventory returns. It is an asset strictly for the reason that it's really almost kind of like when you're looking at this all together. The reason why I have a problem with calling this, I would call this an other current asset, because it's really about the amount of the value that I'm associated with this potential return coming through to me. So if the customer does give me back the item that relates to this, I am going to be potentially receiving this amount back from the customer, okay? So this is to record basically sales allowances for remaining unconditional right of return. Okay, so this is one way of going through and doing it, and let's just walk through this again, okay? So key point in here is that there's an unconditional right, meaning they can turn it in for whatever reason. It's like Nordstrom's. Okay, so the right of return extends for 4 months, and they estimate the returns at 20%. So clearly they've been in business in a while, and they can make this. As an auditor, you would have to go through and evaluate this. So when the asset is initially gone through and sold, this is the journal entry we do. Again, if the sales, if this is unfamiliar to you, let's just go over here to go to 202A, or just right here. And I want to go here to, let's take a look. So I think I called this everything. Where did I put this? Okay, link to requirements, Tchaikovsky office hours, exam 1, general information. Okay, so videos from accounting 1A. Okay, and this right over here, I would go to this section, all down here, inventory, right? So this is what you want to be going through and looking at, this inventory from a seller's perspective. Very, very important. So coming back over here to this, I recorded the transaction. I then record the sales returns and allowances. This should be pretty straightforward. The question said here, it was not said that, it should have said that the amount was paid on March 15th. I'm making the inference because it's here. And then what we have to do is at the end of the year or at the end of the quarter, when we're actually preparing financial information, I then have to say to myself, is like, okay, what is the, well, I wouldn't give this to you, but over here, it's essentially that, what are the estimated remaining returns? So this is how they got to that 200,000, okay? Because they sold 1.5 million, they estimated at 300,000 or 1.5 million times 20%. They've already had returns to date of 100,000, so they're remaining estimated returns. So because over here, what I need to do is I need to do sales returns and allowances, which is a contra-revenue account, right? And when I look at this here at the end of the quarter, I'm going to have sales of 1.5 million plus sales returns and allowances, which is a contra-revenue account of 300,000. Where did the 300,000 come from? Basically, when I go through here and I've got this 200,000, and we can go ahead and do this on 331. Okay. And then I'm also showing over here the estimated inventory returns. And then I'm crediting cost of goods sold. Okay. So the way this is going to look on my income statement, it's going to be net sales of 1.2 million. Now, when would I actually go through and record the remainder of this 200,000 of sales is once the unconditional right of return had elapsed, then I would basically go through and then I would basically debit cost of goods sold. I would credit estimated inventory returns because now that item is sold. I would debit AP and credit sales revenue because then the liability would no longer be there. Okay, so this is one way to do the transaction. Now, I'm going to share with you what I went through prior to doing this question. In the words of Rocky or of Mr. T, I'm Professor T channeling Mr. T. Pain, Balboa, pain. If you don't know what that means, go on Rocky, or just go to YouTube and look up, just type in pain, Balboa, pain. Let's see if we can see this. Let's see, let's have some fun. Pain, pain. I don't know if any of you are watching this, so Rocky 3. Okay. And we can't hear this, but if you see this right over here, let's see if I can do. Okay, okay. So this is Rocky Balboa. So it's pain, Balboa, pain. So it's good stuff. All right. So we've now gone through and we've done this particular part. And what we're now ready to go through and do is to do the other one, which is the one I was having trouble with. But we're going to go ahead and explain this. So I'm going to explain the alternative way of going through and do this and why your book solution to this is incorrect. So this is one way to do it. We're coming up with the most important thing is that our net sales that we're showing for the period has this unconditional right basically buried into it. The next way I could do this is I can essentially make the assumption up front that I'm not going to be recording all of this sales revenue. And so for this one, what I'm going to do is I'm going to say date, count, debit, credit. Okay, so if I do this on the net method, which is basically if I'm recording this as revenue net, meaning that I'm going to assume that I only want to record revenue up front of what I basically exclusive of the returns. So the amount of the revenue that I'm going to be recognizing here on January 2nd is going to be my sales revenue. It's going to be 1.2 million. Okay, and why is that? So if I know up front that there is this unconditional right to return, instead of waiting for the end of the month to adjust it, I'm going to adjust it from the beginning. So what I'm going to do is I'm going to credit sales revenue for 1.2 million. I'm going to debit accounts receivable for 1.5 million. And then I'm going to have over here an allowance for sales returns and allowances. Now, at this point, because there is I would want to call this a reduction or almost a contra AR account because, and again, I'm saying at this point because the customer hasn't paid me anything yet. So this is really like a net AR. I'm not really sure if I would want to call this a liability at this point because I'm booking this here, but it's important that we basically book it this way because we want to show the 1.5 million as being the total amount due, but I would probably call this a contra-asset account at this point, or it'd be a reduction at AR because the customer hasn't paid it. Okay, now the next thing I'm going to do is I'm going to go over here. I'm going to be debiting cost of goods sold. I'm going to be crediting inventory. And this is going to be for 750. Now, when I do this, because I'm only recording the sales revenue at 1.2 million, what I need to do is to say, okay, if I'm saying that I'm not going to be, I've just shipped out 750,000 worth of inventory, but I'm really recording this net, what I now need to do is do kind of the same thing and say, okay, I'm going to have estimated inventory returns. And what is that amount going to be? It's going to be 150,000. Where am I getting that from? Well, if the 1.5 million, right, this basically this 300,000 is the allowance, right, for basically for sales returns and allowance, because I'm not booking the full amount of revenue. Rather, I'm going to say I'm only going to record 1.2 million now, and I'll record the remaining revenue once that unconditional right to return has stopped. So if this is going to be the amount of my allowance, because of the 50% gross profit margin, right? So this is going to be 300,000 times 0.5. So over here, my estimated inventory returns are going to be 150,000. Okay. To record sales using net revenues. Okay. So this is, let's go through and put this into the T accounts. Very important to do. So I'm debiting accounts receivable for 1.5 million. I'm going to record sales revenue at 1.2 million. And then I'm going to be crediting basically an allowance for sales returns and allowances for 300,000. Okay. Second thing I do here is I'm debiting cost of goods sold for 750. I am crediting inventory for 750. And then what I'm doing here is I'm going to estimated inventory returns as of January 2nd of 150, and I'm going to be crediting cost of goods sold of 150. And this is as of January 2nd. So as I look at this, right, what's happened here? I'm only booking my revenues basically to the extent within the, where there's no, where the 80% that I'm expecting to actually collect. So my sales revenues are good at 1.2 million. My cost of goods sold properly reflects it as $600,000. So that part looks okay because that's going to be basically half of this amount. But because my accounts receivable is being recorded at the full amount, and there's this $300,000 disparity when I'm recording the revenue, I'm basically going to create an allowance for sales returns and allowances. Now, at this point, I would probably call it a Contra-Asset account because they haven't paid. Once they pay, it's more than likely going to become a liability. Okay. So now let's go through, that was a lot of fun. Now let's go through and take a look at the next date. So that's our initial recording. So the next one here is let's assume that one customer returns planters on March 1st due to unsatisfactory performance. Doesn't even matter. They purchased 100,000 of planters from organic growth. So this case right over here on March 1st, before I would basically go through in here and do this, but now because of this, because I made all these allowances, what I can do now is I can say, oh, okay, so my sales returns and allowances, or I should say, I take that back. What I'm going to do here, let's see. Okay, so my allowance for sales returns and allowances. Because I didn't book the full, this is okay. Here I booked the full amount of revenue. Because I didn't book the full amount of revenue, what I'm going to do is I'm going to take it against this allowance for sales returns and allowances. So I'm going to debit that balance here. When the customer returned the item, they no longer owed me the $100,000. Okay, so this is a very important distinction. When I look at this balance here, right, I never recorded. So in this case here, I recorded the sales revenue at 1.5 million. So the sales returns and allowance is going to basically come off that. But because I set this reserve up here, I want to debit against the reserve for $100,000. Here, I credit for accounts receivable. The next thing I need to do is to say, I'm going to basically then debit returned inventory, because I'm actually now physically getting this inventory back for 50,000 or 50% of that amount. And then I'm going to be crediting not cost of goods sold, but because I've already done that, but I'm going to be crediting estimated inventory returns for 50,000. Okay. Okay, so let's go through that and put that into the T accounts. So my over here, 3-1. Debiting that over here, 3-1. I can't wait for the comments on this video. This is going to be like, are you really going to put something like this on the exam? The answer is no, I wouldn't, but I will probably end up covering this a little bit more in depth when we get into inventory. But I still think you're paying that huge per unit cost for my class, so this is the least you should be getting. So debited over here, this is the least I can do for your education. So I've debited the allowance, I've credited accounts receivable. I'm going to go over here, debit return inventory, because now I'm physically getting this inventory back for 50,000. And then I'm going to be crediting my estimated inventory returns for 50,000. Okay, so that's what we've gone through and done here. Okay, March 14th, I get paid by my customers. So this, or March 15th, I get paid by my customers. This is going to be a debit to cash, a credit to accounts receivable. Okay, so over here, 315, 1.4 million. So this is the same journal entry that we had from the last one. Okay, so now at this point in time, okay, my AR is now down to 0. Now, what I was talking about before is that this was really like a contra-asset account, or what I would call a contra-asset account before. I wouldn't call it a liability because they hadn't paid yet. So, but now once they've paid, this is going to be a liability, okay? So we get now down to the very end, okay? And this is where your book is absolutely dead wrong, okay? Because at this point in time, what the book does is they're having you debit sales returns and allowances for 200,000. They're having you credit allowance for sales returns and allowances for 200. Now, what I could do, and the reason why the book is wrong, is that if you look at the solution to the textbook, they're debiting sales returns and allowances here for 200. Okay, my sales revenue is already at 1.2 million. I'm already satisfying this. I've already done that. So if you were, though, to do any journal entry at this point, if you were calling this right over here, if this was a contra-asset account, because the customers have now paid their money, I would go through here and reclassify this as an account payable. Okay, that's the one difference I have here. I mean, I do not agree with your book solution. So again, if this allowance for sales returns and allowances is a contra-asset account, which I believe it is, while the receivables are outstanding, then it should become a liability once the customers have paid for their merchandise. Okay. The only other thing that it's also telling you to do here is basically to debit estimated inventory returns and then credit cost of goods sold, which doesn't make any sense. And the reason is because if I did that, it would be hammering it again for no reason. My cost of goods sold number right now is good because I already made adjustments to it, you know, at the very, very get-go for those sales returns. So let's see here. I'm gonna just make sure that that's right. I think it is. Okay, yeah. All right, so that is problem. This is, excuse me, this is just an exercise. So this is exercise 1820. This is by far more for me than it is for you, because I've struggled with this recording net revenue, and your book gives the wrong solution. I just think it's wrong. So there you go. Hopefully you enjoyed that as much as I did. I know I enjoyed it. And you also got to see where to look up Payne, Balboa Payne. You learn new things every day. All right, everybody, have a great one, and I will see you on the next video. Have a good one.